Welcome, everybody, to another episode of the AgView Pitch. Today we have our special regular guest, Paul Neiffer. How's it going, Paul?
Yeah, I'm doing good. I notice, here I'm an hour earlier than you. I got sunlight coming through my drapes right on my head. So,
Yeah. Yeah.
but that's okay. That's
Yeah,
okay.
that's all right. It just shows all that intelligence
Oh,
over
yeah,
there.
yeah, yeah.
Yeah,
And like I say, I really dressed up for it today because I'm going to go play pickleball as soon as this is done. So,
yeah, that's all right. You're always playing pickleball after we record. That must
I
it must
I
be
pretty
that
much.
pre-retirement. You're not retired, but you're kind of in that pre-retirement stage,
Well,
right?
I call it the pickleball diet. Yeah, I think since I've started playing pickleball, I've lost 25 pounds probably, and I'd like to lose about 10 more, I think. So,
Wow,
but
sounds good.
I won't get down to my marriage weight. When I got married, I was way too skinny, but I
Yeah.
think that's true for a lot of us.
Yeah, Patty's probably chasing you around the house and stuff, so that probably helps too. That just continues the weight loss, You're
Well, no, she's chasing chickens and gardening. So,
okay.
I'm number three, or actually, we got dogs, so I'm number four on the list.
I see
So,
how that works. Yeah. Well, no wonder you got to go play pickleball once in a
yeah,
while. So,
yeah.
all right, sounds good. Well, hey, the topic at hand here is this new big beautiful bill. We talked about that. I don't know how long ago it was, what, a month ago or something, about the stuff that was going to be in it. Here it is now. It's signed, and so we wanted to get together here as quick as we could after Trump's Iowa announcement. I watched it the other night, and he was as entertaining as usual. He
Ex-
doesn't always explain everything in the best.
Yeah.
He goes off on tangents. I'm guilty of that occasionally myself, but he gets off on these tangents, and then you're like, okay, what did he say? So, and specifically, I want to dive into how does this, what are the things that most impact farmers? And so you sent me a pretty long list last night, and I think that's something that we want to kind of tackle on some of the key things that you think are going to be impactful for farmers. I'll kind of let you start, and then, like I said, I got some questions on some of the things here too.
Yeah, so let's just go through and the interesting thing is we've known what most of these were going to be for almost a year now. The House Ag Committee last year pretty much teed this up for us. So we've been talking about these for quite a while, but let's just go through some of the key ones and we'll skip the income tax related till the end. We're going to key in on the farm stuff. So um, I did a blog post earlier this week, and my estimates based on the changes to the effective reference prices for PLC is we're looking at a minimum an extra 7 billion of payments going out between ARC and PLC starting in October of next year. And uh, and how does that work? Well, essentially, the Senate revised how the effective reference price is recalculated based on 88% of the Olympic average of MYA prices. That sort of gives us the floor. Now, the maximum is still 115%, but that basically, with the fact that all the reference prices went up by at least 10%, some cases 20%, plus that 88%, we're looking at a much larger payment for ARC and PLC starting in October of next year. Also, base acres, we're going to get that probably 30 million extra base acres. If you look at base acres right now, we got about 271 million of base acres. It's going to ramp up to about 300 million, maybe 301 million. And then the nice feature, and we had talked about this, or I know I've talked about it, is you signed up for ARC and then they made all these changes, Chris, and you're like, well, I don't want ARC, I want PLC. How's that going to work? Well, they made it easy. You're just going to get the higher of the two. So if you signed up for ARC and the payment is $30 per acre, and if you'd signed up for PLC, you'd get $60 per acre. You don't have to go into the FSA office. You're automatically going to get $60 per acre. So that's good. Now, on the ARC, instead of having an 86% guarantee and a maximum payment of 10% of what's called benchmark revenue, they boosted that up to 90%, and you're going to have a maximum of 12%. The House was at 12.5. The Senate ended up being at 12%. And then on the crop insurance side, well, actually, let's talk about the payment limit. If you make all these changes and they still kept the cap at 125,000, most of you, including you, Chris, you wouldn't get any extra money. So they actually bumped up the payment limit to 155,000, and then they're going to index that to inflation, so it'll start going up each year. And then for a lot of our growers out there, I get these questions all the time. Hey, Paul, I'm structured as an LLC. I'm structured as an S corporation, but I have three or four owners and we're all equal owners. Do I need to switch over to a general partnership? Excuse me. And under the old rules, I would have said, yes, you need to switch over to a general partnership. Under the new regime going in right now, LLCs, LLPs, LPs, S corporations, they're all treated as if you were a general partnership. So that means under the old rules, if you're an LLC and you had four equal owners, you had one payment limit. Under the new rule, you got four payment limits. So you don't have to restructure going back to a general partnership and so on. So that's really good news. And
Question on that, Paul.
yeah,
Of course, because my family has a C corp. The C corp's probably still excluded from that
you're
because
still stuck with one payment limit for
because
C
we get all
corp.
the other tax advantage on the other side. They don't want us
Yeah,
to
yeah,
have cake and eat it too, right?
exactly, exactly. Well, and I think what the reason they did this is that the difference between an LLC and a general partnership, really, there is no difference other than the fact that it provides limited liability. Well, why does that affect your payment limit? Now, I guess you could say the same thing about a corporation, but a regular corporation is sort of treated as a standalone entity. So that I can understand why they didn't treat that way. Now, we're going to have a benefit and we're going to have maybe a detriment. The benefit is for a lot of our programs, including the new disaster program, which may get announced on Monday. I think it'll be later, but it's close. Um, a lot of times you qualify for an increased payment. So let's say your payment limit is 125,000, but if 75% of your AGI, your adjusted gross income, is from farming or more, then you automatically qualify for a double payment limit. Doesn't mean a double payment, just a double payment limit. Well, it's been very difficult under the old rules for you to qualify as that farmer because equipment gains were hardly ever considered to be farm income. Well, this bill automatically says that equipment gains, agritourism, direct marketing of agricultural commodities to consumer, that's all now automatically considered farm income. So that's beneficial. Now, where you might start running into some rub is before general partnerships didn't have to do an AGI calculation. You only looked at the owner. My understanding of reading this bill is partnerships, LLCs, et cetera. Of course, LLCs always had to do it, but partnerships are also going to be subject to the AGI rules. And I think there's a good chance that FSA is going to change the definition of AGI to bring in more sources of income off of what's called Schedule K. If that happens, a lot of these, like dairies that also participate, a dairy has a lot of gains from selling cold cows and so on. Under current rules, none of that income gets included. I have a feeling that FSA may start, bringing in all that income on Schedule K. And so some operations, some farms out there may no longer qualify for a payment at all because their income's too high. We'll see. That's just me surmising.
Yeah. And then what about if you're like an owner and so let's say there's four owners in the LLC, like you talked about, and one or two of the owners has an additional profit center, maybe with their spouse or whatever, and then that business gets you close. Does that get added on, or is that just
Yeah,
have
so
to
remember
be
your
back on
payment
its
limit
own?
is always at one social security number, so to speak. So let's say you have the LLC and it's getting close to maxing out on payments, and one of the owners got their own Schedule F operation, and he or she is getting close to maxing out at payments. You don't get two payments. They're going to allocate, they're going to restrict. Now, it may be the LLC loses part of their payment. It may be that the farmer loses part of their payment. It really depends on who's being paid first, so to speak.
Yeah. And what
Uh,
if it's not a Schedule F if the same thing occurs or not?
it could be, you could
Or a
have
trucking
six
business.
LLCs. They're all going, they go down to four levels of ownership. So if you're really concerned about that, get down to that fifth level. Of course, that's a little difficult.
Yeah.
That's a lot of layers. So that's something you got to be concerned about. And then finally on crop insurance, Chris, we got very good beneficial changes there. SEO is going to be similar to ARC in that the guarantee can go up to 90% instead of 86%. The subsidy goes from 65% up to 80%. And you no longer are restricted to only filing for PLC in order to get SCO. You can either sign up for ARC or PLC. Now, some people have said that if you sign up for ARC and SEO, you're sort of getting a double benefit. Yeah, maybe. But who knows on that. And then beginning farmers now have a 10-year premium subsidy, and they've increased the premium subsidy. For the first 2 years, it's at 15%. For the third year, it's at 13%. And then from years 4 through 10, it's at 11%. And then on your regular RP coverage, your revenue protection, whatever those yield protection, revenue protection policies, you're going to get an extra 5 percentage point subsidy on your premiums up to the 75% level. And then at the 80 and 85% level, you're going to get an extra 3 percentage points. So I think 85 goes from 38% to 41%, if I remember right. I don't have that in front of me, but I have it on another chart. But at least that's my memory.
Okay. Um, as far as I mean, that's kind of a cool deal there with the beginning farmer because, but I had a question. So, like, let's say they're at year 4 already. Does it? They just got 6 more years then,
I I
probably, or do you know how that
I'm
happens
not
already?
sure on that whether this is retroactive or whether it's prospective. I'd have to look at the code changes again, or it may be that FSA will make that interpretation. I just don't know on that, Chris. So if you're already a beginning farm, well, let's take the case of Sloan. Maybe
Mhm.
Sloan signed up. He's been doing it for a couple of years. Is he going to then get a bump up? Is he going to get 10 years instead of 5 years? I just don't know on that. We'll have to
And
wait for the details.
yeah, the reason I asked too, that'll be interesting just because we're doing so much transition planning right now with operations, and we have a lot of people. I don't know, maybe 30% of the people we're working with have somebody in the operation that's in that a little ways, a couple years or 4 years now,
Yeah.
maybe in.
Yeah.
So anyway, that'll be interesting to kind of find out. Hopefully people can, those who are participating would be able to continue that to year
Yeah.
10. So
I think the bottom line for me is this is if I was grading it from an A to an F, I'd give it at least a B plus. I mean, this is a pretty good um, all of these changes are beneficial to farmers. Now, again, could they have made these retroactive changes on reference prices effective for the 24 crop that's going to be paid in October of this year? That would have been very beneficial. But the farmers got ECAP this year. I think that was about 10 billion. Well, we've gotten 85% of it. We're probably looking at an extra 10 billion potentially coming in next year automatically from ARC and PLC that I think a lot of us weren't necessarily counting on. Now, I know historically, Farm Doc Daily, University of Illinois, they've come out and said, hey, under the farm programs, it benefits the southern crops. And to some degree, they're correct. I mean, rice farmers are probably going to get an extra $150, $180 per acre. Cotton and peanut farmers maybe an extra $100, whereas corn and soybeans maybe an extra $30, $40. But you got to remember, we got 95 million actually base acres. We're going to have 110 million base acres of corn, and we're going to have like 4 million base acres of rice. Yeah, we don't have enough in the budget to benefit corn at the same percentage as we do rice. That's just never going to happen.
mhm. And then, not to get off subject before we get into the tax related income changes, but the SDRP, that's
Yep, the Supplemental
that's,
Disaster Relief Program.
yeah.
I've almost got it memorized. I almost got those initials memorized. Uh, the dashboard still shows Monday, July 7th as the date you can actually sign up. I have heard that the local offices were trained on this program this week. So we're taping this on Friday. So they were trained, I think, Monday, Tuesday of this week. I've not heard an announcement. I have not seen it published in the Federal Register because remember back when we had ECAP, that was published in the Federal Register, how they calculate it and all the details. Typically, you're going to see it published in the register before USDA announces it. So I have a feeling it might be later next week or early the week after. So maybe it's a week away or so. But and that's where you're going to get the payment for 23 disaster, 24 disaster. The first go round is based on that you were under the crop insurance program. Don't know how ECO and SEO will be um, done. Don't know how much the payment will be as far as percentage because you're not going to reimburse the whole disaster. Don't know how much of the crop insurance premiums will be reimbursed. There will probably be some reimbursement. So we should have those details here within a week.
Hmm. That'll be interesting. We probably need to reconvene for that, for the
We
details on
definitely
that.
will on that one. Yeah.
Okay. All right, let's I think we've kind of hit the some of the key things directly to the farm, but there's a lot of indirect tax things that are occurring that are going to impact the farm as well. Some directly and some a little bit indirectly. Why don't you highlight some of those? I got a couple of questions based on what as you
Oh
highlight.
yeah, I mean we could spend an hour and a half going through all my lists, but actually I'm going to start with a really minor one that I think a lot of the people that handle accounting and bookkeeping is going to like. Right now, for you to file a 1099 to report, a 1099, it's only at the $600 level. Well, this bumps up to the $2,000 level. So again, that should have been indexed to inflation a long time ago. But I think there's really four or five key things for farmers that are really beneficial that we'll key in on. First, the lifetime exemption. We're all worried that we're going to have to do a bunch of gifting this year. That's bumped up to 15 million starting next year, and it's permanent. There's no temporary, it's permanent. So that means a married couple farm couple can be worth 30 million and not owe any federal estate tax. Now state estate taxes can come into play like Minnesota, Washington State, Oregon, but it's at 15 million. The bonus depreciation, remember a lot of our farmers out there when they buy equipment, they buy and build a new machine shed and so on, they were able to deduct 100% of that, and then that dropped to 80% and then 60%, and this year it was going to be 40%. Actually, it's now 100% bonus depreciation permanent as of any asset placed in service January 20th of this year or later. So that's really beneficial for our farmers, especially when they're trading in farm equipment. They get to deduct 100% of the new trade-in value. Even though they pick up the gain, it sort of ends up being a wash. So that's good. Section 179 for this year is bumped up to 2.5 million. So it was about 1.4, 1.5, somewhere in there. It's an extra million or so. And I thought that was going to be effective in 26. It's actually effective in 25. So some farmers might say, hey, I don't want to create a net operating loss because I know the value of that isn't very good. So I'm going to elect out a bonus. They can elect out a bonus. And I have 2.5 million of Section 179 available to deduct my equipment at the level that I want it to be. So it allows us to optimize that information. Now, for those farmers such as yourself, Chris, you're in a state with state income tax, Illinois, Minnesota, et cetera. The state and local income tax limit is bumped up to $40,000. But once your income goes over $600,000, it drops back to 10,000. And there's a phase out between 500,000 and 600,000. Now, for most farmers, typically they're going to be under that level anyway. Your child tax credit, So for people that have a child, a qualifying child, that's bumped up 200 extra dollars. So it's $2,200. All of the tax rates at the lower tax rates, those are all permanent. And let me just take a quick look here. Interesting, banks. So, we have a friend, you and I, we know him well. He's
Mhm.
a part owner in a bank. When they make a loan to a farmer for farmland, they now will be able to deduct 25% of that interest. So that potentially would drop the interest rate potentially somewhere between 25 and 50 basis points would be my estimate. So
And the
that might
banks will
help.
probably pass that just directly back onto the farmer, right?
Yeah, that's why I said potential. I underlined the word potential. So
Just give us
you want to
half
say,
the
okay,
share.
Mr. Banker, what was your rate before this law passed, and what's your rate now? And we'll see if
Mhm.
it's any different. So,
Mhm. And
and
that
then finally,
effective 25, right?
that I forgot to look at the phase in. That's either 25 or 26. I'd have to look at the phase in. I forgot to look at that. And then Section 45Z, uh, essentially starting next year, no foreign feedstock will qualify for the credit. There's a 2-year extension. The your score can't go negative. Now that isn't really for the farmer. That's for the biofuel producer. And then indirect land use is to be ignored. So that definitely helps soybeans, especially for like biodiesel. So those are some of the key ones. Now, I mean, there's plenty of other. We know all the clean energy credits. A lot of those get terminated very quickly. If you want to buy a new EV now, most of the people on this listening to this post probably are not wanting to buy an EV. But if you want to buy an EV, you better buy it before September 30th because it disappears after that date, the $7,500 credit.
Curious also what that means for solar and wind and stuff because there's a lot of funding in there as well. And
Yeah,
how
solar and wind, basically, you better have the project in, I think it's in service by the end of 27. It's either 26 or 20. I think for solar and wind, it has to be in service by December 31 of 2027. So you have about 2.5 years to get that solar and wind project up and running. If you miss that, then you're not going to get the 30% tax credit.
hmm I see
And
the
we have lots of farmers out there that are, seriously looking at doing solar and wind.
mhm.
Now they say this is the death knell of those type of projects. Yeah, that's not going to happen. I mean, if you have if you have these power companies who the state government is saying thou shalt have a certain amount of energy from renewables, they're still going to do it. It's going to cost them more, but that cost is then going to get pushed onto the consumer. You and I are going to pay for it.
Yeah, for the extra
Yeah.
energy.
Yeah.
Also the capital gains looks like in 4 installments that
Yeah. So, I was thinking originally Senator McConnell's bill, which was going to allow you to have tax free on sale of farmland if it was going to be held in production for farming for at least 10 years. I did a blog post on that. That isn't what was in the bill. We have a new section, what's called 1062. It simply says that if you qualify, you can elect to defer the payment of that gain or the tax on the gain. So you'll owe one-fourth of it, on the due date of the return, and then one-fourth the next year and the year after and the year after. Now, there's a restriction. It has to have an easement or an agreement that says that land has to be in farming for the next 10 years. And if they break the easement, although the original Senate Finance Committee had more draconian language, this one, it appears some of that draconian language was removed. This is not going to be that beneficial. I mean, yeah, it'll help a little bit, but it's not going to help that much.
yeah. You had a note here too on charitable contribution changes. What does that mean? Is
Yeah,
it
so if you're don't itemize and you're a single, you can deduct up to $1,000 of charitable donations. If you're a married couple, you can deduct up to $2,000. So, you just get that's an extra automatic deduction for almost everybody, it seems like. Now, it does, penalize people who itemize because they're in that situation, 0.5% of your gross income. So let's say your gross income is $500,000, 0.5% of that would be $2,500. That's not going to be non-deductible. Sort of like the medical costs. Your medical costs you can only deduct once it exceeds 7.5% of your gross income, adjusted gross income. Here it's on charitable contributions, the first 0.5% of your gross income. At least we think that's what it is. They call it a contribution base, and I've heard everybody refer to it as Maggie, modified adjusted gross income. But when I read the actual bill, it talks about this contribution base, but then it doesn't define what a contribution base is. So
Mm.
that may be some type of technical corrections that they have to bring in, but pretty sure it's based on your AGI.
Okay. Last couple of questions here. It's kind of in the middle of some of the notes you sent here. Because last time we talked, you're like, the no tax on tips. There's no way he's going to get that in there. And you have that on there. So is
Yeah,
there
yeah.
restrictions?
So yes, there's up to a certain amount you can deduct, or so let's say your tips are $12,000 for the year. That's going to be under the maximum. The maximum is 25,000. On overtime. Now this is time and a half overtime. So farmers that pay overtime, if straight pay, that doesn't qualify. It has to be time and a half or better. Um, so on tips, you can deduct up to $25,000. On overtime, if you're single, you can deduct up to 12,500. If you're a married couple, you can deduct up to 25,000. But once your income starts going over certain phase outs, 75,000 for singles, 150,000 for married couples, that starts phasing out. So if you're a lower income taxpayer, you're going to get a full deduction for tips and overtime, plus seniors. So myself, I'm age 65. I could qualify for an extra $6,000 deduction, whether I had MIs or not. My wife could qualify for an extra six, but she's not 65 yet. So a married couple age 65 could qualify for an extra $12,000 deduction. That's sort of how they got the no tax on Social Security, because you can't do that as part of budget reconciliation. However, in my situation, or a lot of people's situation, once your income goes above, I think 150,000, you start to not get it. I'm fully phased out, so I won't get that extra deduction.
Hmm. I just was thinking that, at 12.5 on the no tax on overtime, I mean, some of our clients pay overtime and some don't. Most don't because,
Yeah.
you work less hours in the off season, more in the on season. But I was thinking if it was more than that, and maybe some people will do it anyway, but that'd be a way to.
But remember, it's got to be time and a half. So
Right,
if they're
right,
just paying straight time,
mhm,
that doesn't qualify. The no
right,
tax on
right.
overtime has to be at the a time and a half rate.
Yeah, yeah. So it's a half again as much, but
Yeah.
there'd be some ways to play that game. I guess I'll leave it to
Yeah.
people's
Yeah.
imagination on how they can
Yeah,
do that.
exactly.
The last one is the no tax on vehicle interest. Explain.
Yep. Yep. Yeah. So, and they call it a qualified passenger vehicle, which is more than just an automobile. It's a van, it's a motorcycle, it's any qualifying motor vehicle under 14,000 GVW. Um, then you will get a deduction up to $10,000 on that uh, vehicle. So if you buy a new vehicle and you're paying $7,500 of interest on that vehicle, you get the deduction. However, once your income goes over, I don't have it in front of me, I think it's 150,000. As it starts going over that, you get no deduction or it gets phased out. So you just got to be careful. All of these have different phase out numbers and phase out percentages and so on and so forth.
Mhm. Some of that stuff will be interesting though for a lot. I mean, some of that the three we just talked about are probably more applicable for some of our employees and how we can help them think
Potentially,
in tax
yeah.
management,
Uh,
which has indirect
Yeah. Now,
benefit.
tips are not going to qualify because farmers typically is not a profession where tips,
Mhm.
it restricts it to industries where tips are typically allowed. So that's going to be hospitality, Uber drivers, restaurants, casinos. that type of situation. They're going to specifically restrict it to that industry. Now, overtime, the only restriction is that it has to be basically time and a half or double time.
Hmm. Yeah, this isn't a question, but it's a comment. I was talking to you, the other night, uh, or what was it, Friday night here when we had Trump's explanation of the employees, or the illegal, employees
Well,
that
yeah.
farmers have, and that he's, so I'd encourage people to go back and watch that, and we'll see if it actually happens. I mean, he's talking about having the farmers, you know, vouch for their employees and then allow them to stay and be a worker. So that'll be interesting because, and you think about all the struggle that all the guys have, like in North Dakota and down in the South and the Delta and places where they're hiring the H-2A employees out of South Africa. That's a pain in the ass a lot of times. And there's a
Yep.
ton of paperwork. But yet at the same time, if you've got, you know, uh, people from Mexico or whatever that just came across the border, that was a lot easier. And if they're going to let them stay, are we going to continue to make all the South, those who are bringing in South Africans to help on the farm continue to go through so damn much red tape, So
Yeah, and all the cost. I mean, I
yeah,
mean, you got to provide transportation, you got to provide
yeah,
housing, you got to,
yeah.
and they can only be here for 10 months out of the year or 9 months or whatever the rules are.
Yeah.
So,
And I get there's a difference between a certain level of skilled labor versus, manual, just quote unquote, just manual labor, but there's gonna have to
well,
be.
and then a lot of these farmers, especially the ones that, let's say they're in the fruits and the vegetable side, where you have 400 or 500 employees, they're getting sued because they didn't offer the job to the normal American citizen. Well, they offered it, nobody really wanted it, so I'm
Work.
bringing in the H-2A. Well, you didn't really offer it to me, you didn't hire me. Well, this is just attorneys out there trying to make a buck.
Hmm. Kind of like the signs I keep seeing. If a semi violated you, give our firm a call and we'll help you sue the truck drivers.
Yeah.
It's crazy.
Yeah.
But hey, I think this was a really good conversation. It kind of tees up stuff that people, whatever's most applicable to your operation and stuff. I think people are going to want to continue to look at that. We'll do some follow up, as things become implemented. Because it's one thing when it's signed, it's another thing. Implementation is another
Well,
component.
and the nice thing about getting this signed now versus when, so in Trump's first term, they spent a lot of angst and turmoil trying to get Obamacare overturned. That didn't happen. And then they got the Tax Cuts and Jobs Act, but that was like the end of December, and nobody knew what the rules were, and nobody could do anything about it.
Hmm.
Hey, here we got a full 6 months, not quite exactly 6 months, but we're pretty close to a full 6 months that allows us, oh, okay, now we can start planning. And like you say, hey, we know what the law is. Let's take advantage of it.
Hmm. And I think the key is what you just said is, next steps for the listeners is give your CPA firm a month or
Yep.
so to digest and metabolize some of this, but then maybe start having that conversation instead of waiting until, your tax, quote unquote, tax appointment or the time to get together to plan. It's like, okay, here's where I think we're at, maybe getting together proactively and saying what of these new items are applicable to our business and kind of get a plan put together so we're not doing it at last minute. Is
Yep.
that good advice?
Yeah, and I hope a lot of people that were, let's say, in that 5, 10, $15 million range, hopefully they didn't do a lot of unnecessary estate planning steps, like setting up a bunch of trusts that now they don't understand, and so on and so forth. Because with this bill, all that they don't even have to worry about.
Mhm.
So now, when we say permanent, with Congress, who knows what permanent means, but all we can say is the lifetime exemption has never gone down, other than we had that quirky 2010 we won't talk about, but it's never really gone down. So,
Yeah.
so we'll see.
And I think part of that planning, though, what happens for some, at least from what I've seen, as we continue to increase the, helping people on transition planning is the state by state differences too.
Yep. Yep.
And
Yeah.
that's
Like
where,
take my old state, Washington State. They now have a top tax rate. If you die in Washington, your top tax rate's 35%, and it kicks in at $9 million of net worth. So, you're a farmer in Washington State, you're a little bit concerned about it. Now, the benefit in Washington State, unlike some states, is if you are a qualified farmer, all of your farm assets are exempt. Your farmland, your farm equipment, so on. That all in most cases, gets reduced on that estate value. So if you have other assets, then that's going to be subject to the estate
Yeah.
tax.
Some of the other states we see challenges in is Minnesota and Illinois
Yep.
as well.
Minnesota is nasty. Illinois is nasty.
Yeah.
3.5, 4 million. Doesn't take much in the way of land to start getting hit with
No.
that.
And that's where we see in those states some people getting fairly aggressive at separating some things out and structuring things a little bit differently. And it's great that the Fed is helping us out, but I think the states, when you get some of these states that need money because they don't know how to spend money very effectively, or they're good at
Or
spending money, let's put it that way. But
Yeah, a lot of those states, they're very progressive too. They
mm,
want to do wealth redistribution. I mean, that's essentially what it is.
right.
So
And it's just so
it,
unique from the farming side of it though, as an industry. That's what I struggle with is the inability to see, the differential between the ag industry and some other industries that they're trying to go after, and not having any kind of an exemption in some of those states is interesting to me. But
Well, and that's why a lot of those people in those states are moving to Florida or Texas, because once you move out of state, the personal property becomes exempt. Real property can still be subject to the estate tax in that state. So, but so you can get around it a little bit, but you
and,
have to go through a lot of hoops.
yeah, and I've
So,
seen 3 or 4 cases here just in the last year where Minnesota landowners that are not farming, that are just senior landowners, are selling the land in Minnesota and buying it in Iowa.
yep,
I
yep.
mean, you set these these expenses up for people. They're going to move. They're going to adjust. I mean,
It's a law of unintended consequences. It's like Washington State. Jeff Bezos left the state primarily, I think, because of the capital gains tax that was enacted. And
mhm,
I think he knew what was coming down the road. So
yeah,
Bill Gates doesn't care to some degree because all of his is going into a charitable trust anyway.
mm,
So, uh, but uh, but actually, Washington State had a thing saying there was a provision that didn't pass that you would no longer be able to deduct 100% of the charitable contribution for an estate. So I think eventually that will become part of the Washington State law. At that point, if that happens, Bill Gates is gone. He's no longer going to be a Washington State resident.
mm. Interesting. Yeah, it's like you said, unintended consequences. It's
Yep. Yep.
you think you're fixing something, and then the water breaks out of another
Yep.
hole in another spot of the boat. So,
Exactly. Exactly.
all right.
So.
Hey, this has been a great conversation as usual. You're a great friend to the farmer. You bring a ton of absolutely really good content and just perspective to people. And if they want to, if some of the people are not on your blog, explain that real quick because
Yeah.
that's a great place for info
Yeah.
too.
So my blog is farmcpareport.com. Now it is subscription based. The fee is about $500 a year. However, probably 15% of the posts are free, so you'll be able to read the whole post. But as Chris says, I think I try to post at least once a day. Now with the stuff going on right now, maybe I'm posting 2 or 3 or 4 times a day. So that's the easiest way to keep up on everything that we're talking about.
Yeah, I mean, it's just the information you put out. It's just tons and tons of value, and the cool thing about it is it's like timely. It's like in real time. So,
It,
um,
well, yeah, I'm living it too. I'm quote, I'm tech. Well, I guess I view
I'm a
myself as a
farmer.
farmer. I'm a
It's
crop
okay
share farmer, but
okay if you say, Paul, I'm a farmer. It's all right.
yeah,
You
yeah,
are.
I know how to drive operate the combine and the
Yep.
tractor
Yep.
and plant and so on. So
Yep. Yep.
now I don't get to do enough of that, but I know how to do it. And
Just
of
because
course,
you're
I market my crop and I pay for the inputs and so on. So
just because you're an expert CPA doesn't mean two things can't be true at the same time. You can be an excellent farmer and an excellent CPA.
yeah,
It's okay.
yeah. Plus, unlike you guys in the Midwest, I've slid a combine down the hill. You guys typically don't have that privilege.
We're just
So,
flatlanders. We don't
yeah,
know what we're doing. We go
I
back
know.
and forth in a straight line, so
Yeah,
it's
yeah,
fine.
yeah. And you've been out there to see it isn't that flat out where I grew up.
There's a lot of
So
harvest going on out there right now. I think, or at least it's getting
it's
rolled
getting
loose.
started. I would say, yeah, right now it's probably about when it'll be in full swing, probably about another week and a half. Middle
Mhm.
of July is usually when starts hitting full swing.
Cool. Well, hey, this has been a great conversation. I think there's going to be some questions if people want to reach out to you or throw questions your way. Is there a way that they can?
Yeah, the best way is just send an email to me, farmcpa@outlook.com. That's always the best way to get a hold of me.
All right, sounds good. Hey, thanks a lot, Paul. Better let you go play pickup ball.
Okay, sounds good.
All
Thanks,
right, have,
Chris.
have a fun one. See ya. Thanks, everybody. We'll catch you again next time on the AgView Pitch.